Welcome everybody. This is George Veeder. I wanted to welcome you into the new year, 2016, and address a little bit of the market volatility that we've been experiencing year to date. Many of you have been calling in and are concerned with the drop in the first week of the markets. So I wanted to tell you our perspective or communicate our perspective about that. We woke up Monday morning after New Year's to a world concerned about North Korea and a bomb experiment in North Korea that shook down into South Korea. And these type of geopolitical events, even though they're not uncommon per se, especially not this type of event, they tend to make everybody concerned. So the market traded down on that news. Then we had the Chinese volatility in their stock markets that first week. And we had the Chinese government trying to do things, or in some ways experiment in many senses, with how to better control the flow of their market and investor anxiety over their failure to calm their markets. Then we had oil prices continue to go down through the week in response to soft data points on oil reserves and oil supplies, inventories, which led to oil prices and the concern over where oil prices are going to go, rattle markets as well. Then finally, a dollar, US dollar, that continued to strengthen in its record pace, which creates concerns or headwinds with US companies that sell products and services abroad, how that would affect their exporting. All of this kind of conspired to create an environment which led the markets down almost 6% or about 6% in the first trading week of 2016. And then a lot of media attention around this, focusing on the fact that in a long time, maybe in the history of the markets, that was the worst first week of the year. And as that news was disseminated, there was a lot of client anxiety over what we should be doing, obviously, as your advisors to respond to this. So I wanted to have a discussion with you on how we view these things, how we put it in context, and how we view our role in supporting you, understanding your anxiety, but guiding you through this moment going forward. One of the things that our clients come in with as a concern is whether or not they should be in or out of the market, especially when we have these moments of extreme fear and associated volatility. So we've been framing the discussion all week, and I wanted to put this into a video blog, how we view our role in best serving our clients, whether or not we should be in the market or just ride through this moment as all the other volatile moments that we've experienced together as clients and me as your advisor and our team. As far as the discussion of whether we should be in or out, that is under the general premise of market timing. And our feelings on market timing are this. If we could perfectly market time, know when the market's about to go down and know when the market's about to go up, we would love to be able to perform that particular service for you. But history has taught that nobody gets market timing right all the time. In fact, I read a very interesting article that was initially published by Forbes magazine, January 11th, 2013, and they quote research by an organization called CXO that they actually surveyed and kept data on market predictions by market gurus that published their findings over a 10-year period from 1998 to 2008. There were over 5,000 of these predictions that they saw through from their pronouncement to how they ended up. And their data concluded and leveled out that there was a 48% accuracy rate to those predictions. And they were just general predictions that the market was either going up or going down. So that leads us to believe, based on the actual data, that it's kind of a flip of the coin. The smartest people in the industry that hold themselves out to be gurus are right less than 50% of the time. So there's a huge risk in that. The risk is that if we decide to go out of the market when we feel things are getting very precarious or concerning, we go into cash, let's say, And let's say the market turns around and starts an uptrend and we miss that. There's a risk that that could happen and we miss the return to market highs or even the next market uptrend. And our experience has been, if we even were right most of the time, the times that we would be wrong could just ruin our average returns in the market over a period of years. So we feel the risk of trying to time, no matter how smart we think we are, or no matter who we would follow in that endeavor, is much greater than staying in the market. Now, the reason I say that is because over time, the market has a tendency to habitually reach new highs after every downturn. As we look at this particular slide, the take home here is that the bear markets, as painful as they are, last a lot less time-wise than the bull markets. So the statistics show from 1925 to present, and we use 1925 because that's when the S&P became an index for us to extract data from. From 1925 to present, we have had 9 bear market cycles. They've lasted an average of 17 months. So almost a year and a half that we have to put up with a difficult negative market on average. But then the ensuing bull market runs in between the bear markets has averaged 93 months. So we have a lot more time spent going up than going down, even though emotionally it doesn't feel like that, because we have a disproportionate impact of the fear and the greed emotion. When we're scared, it seems like it's lasting forever, right? But when things are good, even though we enjoy that, it doesn't create an equal emotional charge to the upside. So it seems like bear markets last a lot longer than they do. But again, the statistics are we're going to stay in a bear market on average for 17 months. Then we're going to move to a bull market for 93 months. A bear market is a 20% drop from peak to valley. And then we have the ensuing recovery. A correction is defined by a 10% drop, which we had one in August. We had one in 2011, August, September, and we're most of the way into one after the first of the year. We don't know exactly how this is going to flesh out. We want to make sure that we're always worthy of your trust and your confidence, and we want to be able to assuage your fears whenever there are these moments where there's a lot of tension in the world, because they pass. Happy New Year. Look forward to visiting you next time you come in for your review.